Do you have millions in concentrated positions in a taxable account? Can you diversify and defer taxes at the same time? The answer is yes. Watch our video and find out more. So typical solutions like ETFs or even direct indexing pushed by big banks are incomplete and less optimal. We believe there's a clear winner: long, short direct indexing. We strongly suggest using it for concentrated positions. Hi, this is Todd with Integrity Investment Advisors. In this video, we're going to cover three main points. Why it is important to diversify concentrated stock. Are you okay losing 72% of your stock or more in a concentrated position? How long-short direct indexing performs compared to mutual funds, ETFs, long-only direct indexing. And tax loss harvesting. Long-short direct indexing can typically defer 100% of capital gains in just a few years. Please note this information in this video is informational in purposes. It should not be tax or legal advice. Book a free second opinion so we can get you a detailed analysis of your current situation. First, congratulations. If you own stocks on this list, you can pause this video. Consider yourself very lucky. A lot of these holdings are up 4x, 10x, or even 60x over the last 5, 10, or 20 years. You've made millions on these stocks, potentially. It's also created two massive problems. First, you likely have millions of dollars in unrealized capital gains. And second, your financial future is completely tied to the fate of one or a couple companies. You are one bad earnings report or competitor or regulatory change away from serious losses. Some of these top stocks that we see from clients, our current clients, are NVIDIA, Broadcom, Microsoft, Apple, Tesla, Meta, Netflix, Amazon, ANET, and many others. Even if you've been holding it for 10 or 20 years, many of these stocks have significant gains. Now's the time to take action. Here's a great slide from Brent over at Tax Alpha Insider. If you're not following him on X, I highly suggest you do. He's got tons of great information out there. But this is a study from BlackRock. They ran a powerful study on the top performing stocks in the S&P 500 over a 10-year period. Many of them had astronomical gains. And what they found is a pattern that after these 10 years of explosive growth, it typically tend to stagnate a little bit for the next 10 years. And success inevitably attracts competition, other innovation, and the growth just slows down. So the stocks that got you to very high points may not get you and be a great long-term solution for you over the next 10 years. It makes sense to diversify, and we can show you a way to defer capital gains if possible. Even if your company continues to grow over time, here's data from the last 40 years. Again, many of these top companies had great compound returns over this period. But take a look at these max drawdowns. The S&P 500, obviously 58%, but individual stocks are much more volatile. Some of these down 60, 70, almost 90%. The average for this list was 72%. Those are massive losses and massive volatility over a 10 or 20-year period. Think about it. A $5 million position could easily become $1.4 or $2 million. A $10 million position could fall as low as $2.8 million, $3 million, or something like that. That is a huge amount of risk to take in a concentrated portfolio. You want to diversify out of these if you can over time. You can ring the bell. You made lots of money in these stocks. I think it's time to diversify a good portion of these. Take a look at our link in our webpage for concentrated positions. You will see a ton of information, and we can run a custom report for you and analytics for you. It'll give you confidence about your current situation and sort of a path forward. Here's a great slide showing the evolution of taxable investing over time. So obviously we started with mutual funds a long time ago. They were expensive, not very tax efficient. ETFs are much better for today's taxable portfolios, lower costs and much more tax efficient. What happened recently over the last several years is a lot of companies started spinning out direct indexing solutions. So this is long only direct indexing from companies like Morgan Stanley, BlackRock, Goldman, even Schwab, Fidelity, and Vanguard are all in the game. And they're promoting this heavily because it's a big moneymaker for them. They claim it's superior to ETFs. I don't really think so. They're much more expensive, 7 times more expensive, 20 times more expensive, and it ends up just becoming an expensive mutual fund over time. For multi-million-dollar accounts, what we believe is much better, much more optimal, is a long-short direct indexing solution. Those can provide solid nominal returns, very similar to the index, the Russell 3000 or the Russell 1000, They strive to beat the index with an alpha overlay, and it provides good pre-tax returns and a lot of tax loss harvesting. So it captures more losses faster, smarter, and more persistently over time. We believe this is also much more optimal than an exchange fund. We'll do that in a different video, but certainly more powerful if you have direct indexing. And the good news is if you have direct indexing, we can convert that and bring that in kind to the long-short direct indexing. Very important. A lot of people have millions in direct indexing. We can bring it in kind to long-short direct indexing. Here's a great example of a solution from AQR. This is comparing the standard direct indexing solutions long only to their AQR 145 solution. And what they found is the tax loss harvesting from the long-short strategy are higher and far more persistent. And this is because you have two sources of potential losses to harvest, gains and losses, from the long side of the book and also the short side of the book. Again, we are replicating and hugging an index in this case, but the longs and shorts can add alpha and much more tax loss harvesting opportunities. So if you have concentrated positions and you're using long-only direct indexing, you're only getting half a solution. Studies suggest that long-short direct indexing is much more optimal than cash, exchange fund, or the other exchange funds out there. See our website for some more details. Here's another great slide from Brent over at Tax Alpha Insider. I really love what he does out there on X. This is the AQR strategy. It's a higher leverage strategy. It's called the AQR 250 SMA. It has a $3 million minimum, and it's designed to rapidly reduce capital gains, diversify, and provide some alpha. The tax loss harvesting is a byproduct of the alpha engine and the nominal returns. That's important to know. But on average, over a 2 or 3 year period, this strategy can provide net capital losses equal to about 100% or so of your invested capital. So yes, good nominal returns and capital losses in 2 to 3 years of around $3 million from that standpoint. And that can be used to offset your concentrated positions. Some of your concentrated positions, if you're not restricted, can actually be contributed in kind to the strategy and paired off against the losses. So again, I really love this strategy overall for accounts with 3, 5, even $10 million in concentrated positions. So in closing, long-short direct indexing can help you diversify and defer capital gains. The answer is yes. It's a great solution if you're an investor with a multi-million-dollar portfolio in concentrated positions, mutual funds, or ETFs that are frozen over time with large capital gains, or if you're selling your business or real estate. We love to use long-short direct indexing. Overall, it's a fantastic strategy. AQR is one of the best in the business. You can use it to build a better core portfolio to the Russell 3000 or 1000. You can use it to tax loss harvest, divert capital gains, track the benchmark, and potentially provide excess returns because of their alpha model. So book a meeting so we can review your specific details. We do a great job with this, and we'll help get you set up the right way. So in closing, concentrated risk is a great way to make a lot of money. It is a way less than optimal way to preserve wealth over time. We offer free second opinions. Again, the minimums on these accounts are $1 million in the 145. The 200 and 250 are $3 million minimums, in taxable accounts in this strategy. We can, in kind, bring over your direct indexing, long-only direct indexing. So book a meeting on the call. We think this is an incredibly powerful tool. Everybody's situation is different, and it depends which strategy you need and which stocks you own today. So we encourage you to book this free second opinion meeting. It is a discovery meeting where we do a phone call to assess your situation. If you like what you see, you can upload your confidential information so we can run analysis on it, give you a holistic view of your portfolio and the concentration risk. Then when that's done, it takes us about 5 or 6 hours to complete that. Then we book another second opinion where we share with you the report, the strategy, the red flags with you. You get that report for free. You decide if you think we add massive value and the solution can help you. If you think that's the case, you sleep on it and you might end up becoming a client and we can get you onboarded and start saving money still this year. Obviously, taxes and capital gains work on a calendar year basis, so we can still achieve really good tax loss during the year, and then obviously when January comes, we can accelerate that for the next calendar year. So I look forward to meeting with you. Please let us know how we can help. Obviously, this material is informational and purpose only. It is not tax or legal advice. we need to get a full formal second opinion, and you can consult with your qualified CPAs and tax specialists to see if this makes sense. Thank you very much.